expecting in the budget 2025? Since that's just around the corner, we should drill and discuss down in terms of expectations, especially from the mutual fund industry point of view. Now, will the government change the status quo on debt funds? What are they expecting this time? To talk about all of this, we have Feroze Azeez, Deputy CEO at Anand Rathi Wealth, joining in with us. Feroze, thank you so much. Good afternoon, and thank you for joining in with us in the studios. Budget is just around the corner. We have expectations coming in from across the sector, but the most that impacts everyone in their day-to-day life is the mutual fund industry or your personal investments when you're making that. What are the expectations, firstly, that we have coming in this time from the government's fiscal policy in this union budget that we're expecting? And anything, given that the market sentiment has been so volatile recently, in 2025, anything that could furthermore impact this?
Yes, Vinnii, it's always good to be on your show. Firstly, if you look at budget expectations, of course, there are expectations in different buckets. The economy bucket, which is going to impact the capital markets on the long term, because economy is what drives capital markets in the long run. Then it comes to what's your personal income tax on your salaries and other sections which keep getting modified. Then comes what is your balance sheet. You've invested so much money. What happens to the tax there? P&L is your salary. What's the impact on that? Your balance sheet is nothing but your current investments. What's your impact on that as an individual? And then comes economy, which will tell you where your balance sheet and your investments are going to go. If they put in great emphasis to economy, then India is shining, then automatically your portfolio shines. Your jobs, your salaries increase because the entire country is growing. So now let me break this down into three parts. One, on the economy side, if you look at how the government has behaved, because you mentioned fiscal. Fiscal, if you look at from FY 17, this government has always met its fiscal targets apart from 1 or 2 years. If you look at last year, they spoke about 4.9% for FY 25. We are on track to get the fiscal deficit to 4.9%. Last year also they said 6, they did 5.6. So firstly, whatever they say on fiscal deficit is credible now. There was only 1 year where in FY 22 they said 6.4, but they overshot it to 6.7. And the COVID year, of course, they had projected 4. Then COVID came and 9.2 was the fiscal deficit. So I personally think the fiscal deficit being controlled creates some degree of stability in the debt market. So that's given. Second, very importantly, it's when you look at fiscal, Vinnii, most people look at a fiscal deficit as a percentage of GDP. We look at fiscal deficit as a percentage of your total revenue as a government. If government says I'm going to spend 16 lakh crores more, then the 32 lakh crores which it's going to earn, think of it as a household. If Vinnie's household earns 100 rupees, if you're spending 150 rupees, how much more than your total income are you spending? You're spending 50% more. So that's the current status of the government. So if the government is earning 33 lakhs as revenues, it is spending 48 lakhs. So this number in COVID year had gone to 107%. Aamdani 1 rupya, kharcha 2 rupya. That's what we had reached in COVID. We have come down to Aamdani 1 rupya, kharcha 1.5 rupya. This is coming back to those levels in FY 19. Last year we were at 60%, previous year we were at 70%. Just a couple of years before the COVID year we were 107%. So fiscal prudence as a percentage of revenue is far more important because both are bank account credits and debits.
Absolutely. Feroze, just continuing the point forward, and how do you think any of the changes or what are the proposed changes that we are expecting this time in the budget or the industry has put out for the budget in terms of capital gains, personal income tax, or anything specific that we are watching out for this time?
See, one is what we think is fair to do. Will it get done? Very unlikely. What is fair to do is India needs to have another slab of 15 to 25 lakhs. That's clear that if you're pushing people to the newer tax regime, then you need to definitely give this 15 to 25 lakh slab for the new tax regime. Because salaried guys have been milked enough, and quite a few salaried guys and business professionals are moving to tax havens like Dubai and Singapore. And that's saving them a lot of tax. So you might hypothetically collect 80% tax. But kisse? The guys who are giving you the money are leaving. So that's why bringing this rationality of 15 to 25 lakhs is a fair thing to do. Will it happen? I think probability is only 1/3. The second thing which I think is the most important thing to do for the growth of India and the Indians more so is to abolish two sections, Section 54 and Section 54F, Vinnii, if you've not bought a house or if you wish to buy a house, these are the sections which are not allowing you to buy the house. It's like if I sell a house as a big guy in India, we deal with a lot of rich people. My clients might not be happy if they hear me. Rich guys, what they do? They buy real estate.
Yeah.
They sell the real estate. They make a gain. They don't pay tax.
Yeah.
They reinvest. This is not available to equity. If I sell one stock, make a gain, I pay the tax.
Yeah.
Even if I reinvest in another stock. Why this unfair advantage to real estate? This is the reason why HNI is holding 88 properties in their name. That's why Garibs are renting out houses from these guys. Section 54 and 54F is the major reason why Indian housing is so expensive and more expensive. Mumbai is more expensive than Manhattan, where it's so difficult to reach a couple of kilometers.
Absolutely. But, anything specific, obviously, if this slab rate changes come in, or hoping that all this 54F is removed, what is it that is required for the mutual fund industry to actually, for people to start maybe, looking more of it? We have seen those SIP numbers increase. But where is it that investors can actually get an easier path now? We are getting taxed on whether you have your long-term capital gains, short-term capital gains. So what is it that is required in terms for those benefit point of views?
I think the long-term capital gain exemption of 2 lakhs, if that can be made as 2 lakhs, it will be a great thing to do. Why? Because, but I think we as SSEs also need to take some action. Most people, I met somebody who's just a friend in the building. He has invested 10 lakhs. It has become 18 lakhs. But he has not booked any gain from the mutual fund.
Yeah.
In his family, there are 4 people. If he booked it every year and moved from growth to dividend, dividend to growth, he would have used these exemptions of the last 4 years and made it tax free. Now he is planning to pay 1 lakh rupee tax. तो ये लाख रुपए बच सकते थे. थोड़ा तो दिमाग हमें भी लगाना पड़ेगा.
Okay. Also, what about this, what I'm reading also is in terms of expectations coming in for reintroduction of those indexation benefits on debt mutual fund. So, if you could explain us what was that and how does that actually benefit debt mutual funds or investors on that side?
Yes, it benefits. See, indexation is nothing but a discount to you on account of inflation. If you have made 100 rupees has become 108, if Mehngai or price rise has brought it to 106, you pay tax only on the 2. Because 6 is anyways lost in inflation. So that is the concept of indexation. That has been reintroduced to real estate. It was almost taken away, brought back. Till units of March 2023, there was indexation. Now that has also been abolished. That is, I think, very unfair, and retrospective tax has been reversed for foreign corporates. Why give retrospective tax to Indian individuals? If this government is for the people, then the people can't have retrospective tax and the larger corporates can negotiate and get away without retrospective tax. So I think it's only fair, and I think it's a missed out, more attention to detail has been missed out by the ministry, not an intent to take away something which was almost given.
Okay, are you expecting any sort of initiatives that are aimed at promoting maybe long-term savings or retirement planning, especially through mutual funds? That's what is picking up in terms of pace, and such as tax incentives may be there, or even in terms of enhanced contribution limits, NPS now, that is what everyone wants to look at, or ELSS. Is there anything that we could be expecting this time, or is that the need of the hour especially also coming in?
It's the need of the hour. Would the ministry be looking at it? I think ministry would be looking at it. Now let's look at why do I call it the need of the hour. Last year, 34.32 lakh crores was saved by Indian households, you and me. 34 lakh crores. Isme se, how much you would be surprised, in the newsrooms we speak of 60% equity, 40% debt, 92% went into debt and insurance. Only 7 to 8% went into equity mutual funds and direct equity. Asset allocation in the newsroom is 60-40, 50-50, but India's asset allocation is 92% debt. How do you expect a household to beat inflation with 92% invested in an instrument which is sure to underperform inflation and get taxed at 35%? So I think it's the need of the hour. That's the point I was trying to establish. Second, how do you make it more mandatory and make a budget a catalyst for this to change? Is 54EC. Section 54EC says that if you sell a property, you can buy 50 lakhs of bonds and make yourself tax exempt. Why only bonds? Already 92% is going into bonds. Can you make some ELSS schemes also exempt in 54EC. Then you have large amounts of monies moving from unproductive debt assets to equity assets. So that is where the large needle will move. If you do a 54EC, 50 lakhs per head is a lot of money, which can actually create flight of capital to equity and in turn make households earn double-digit return. I think that's the duty of the ministry.
Absolutely, hoping that that does come in to get those double-digit returns for the households. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more on the budget expectation 2025 after this short break.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Welcome back, and you're tuned into Mutual Fund Corner on CNBC-TV18. Now let's keep it going. And Feroze, you know, the emphasis from the government side in the last few years that we've seen from the budget comes in for that infrastructure side, you know, and they are focusing on whether you look at rail or defense side, and they want to focus on such things. How would this actually come into play for the mutual fund industries? Because we've seen a lot of these NFOs also coming in, whether you look at equity fund or debt fund portfolios. What is the story that one should be playing around such a focus coming in from the government on infra side?
Yes, you're so right. If you look at the infrastructure spending, that was 2.5 lakh crores in FY17. The budget is 11.1 lakh crore now. And last year they set aside 10 lakh crore, out of which 9.5 lakh crores was actually spent. It was not just paper money, it was actuals put in the economy, is why we are one of the fastest growing economies and will remain that way. So if that's the key, 11.1 lakh crore is going to be spent. The actual numbers for this FI have not come in yet. And I wouldn't be surprised if almost 90-95% of that is utilized. Then I think infrastructure is definitely a great story to play. That's why in our Anand Rathi model portfolio, we included SBI infrastructure, which is a little more broad-based, not as thematic as a scheme. That's how, so where our money is, our mouth is what I'm trying to actually articulate. The second thing is solar energy. Renewable energy is something which I think PM Ghar Ujwal Yojana is something which there was some degree of allocation. Not very happy with the allocation. I will be very keenly looking at the 10,000 crore going up substantively in this budget. That's second. Defense, I would say defense took away 4.54 lakh crores. That's a large portion of expenditure. But unfortunately, defense stocks had gone ahead of time because this is not secret, right? If I know it, then most of India knows it. So people had run up those stocks. There's been some reality check in terms of valuation. So defense comes back as a sector. I think most fund managers in the diversified category are already playing this. So if you're going to play this separately in a sectorial fund, you have to also see, superimpose and see, if you have 10 funds, already those 9 fund managers are skewing it here because they know what I know. Practically. So then you buy 2 more funds in the same category, then you are doubling your bets. This is what happened in 2008 with infrastructure. People were buying separately infrastructure, fund managers were buying 60% infrastructure. So people went up 80% infrastructure. Given that disclaimer, I would end my answer to this question.
Okay, that's interesting. So, before anyone actually starts wanting to play such a story, you should look at what you have in your portfolio as well, right? Before you just double down on something, it's important to just keep an eye out on that. Now, financial inclusion, that's also something that has come in as a focus on in the recent times. Do you foresee any specific initiatives that maybe are there or specifically could benefit a mutual fund retail investor in the current time?
Absolutely. I think, financial inclusion is still ahead of us. If we are speaking of some 12, 14 crore folios, up from 2 crores, and folios are not unique folios. There is a lot of intersection in folios. So I think financial inclusion is ahead of us and very little is behind us. Because total equity is last year's savings or total savings also, it's negligible, 6 to 7%. That's point one. So this 250 rupee SIP, which is coming down from 1000 to 250, which is the latest news and you're covering it at the app time, is a very important initiative. Not a very important initiative for tomorrow, but these seeds take its own sweet time, 2 years to transpire. See, because today if you reduce it at 250, when you look at it in the history when amounts have been reduced, not that everybody is so excited, 250 mein main kharidne, nobody's going to go run to buy those. But now you will do prachar, you will do publicity of that, and you will make sure that there's awareness that even a 250 rupees guy can do it. And that will take its 2 years time for it to see its full merit. And I'm very excited about the seed being planted yesterday. That's point one. Point two. Point three is that if you look at the 26,000 crores of SIP, I think unfortunately AMFI doesn't dissect it in terms of amount of SIP. You wouldn't be surprised, and I've done some exit poll kind of analysis, statistically trying to extrapolate on this. 90% of this amount comes from 10% of the folios.
Oh, wow.
Okay. So it implies that the rest of the 10% of the amount, which is 3,000 crores, is coming from 90% of the folios. So that's a great broader base. So I am very happy that more people will benefit from it. Will this 26,000 crore number suddenly shoot up because you reduce the amount? It will remain equal and marginally go up only. So it's good, it's okay for capital markets, but good for Indians. Is what this move.
People will automatically want to just come in, even if it's a smaller amount. Today, you look at the amount of people, I think, who have entered the industry as investors, also in SIP specifically, have also increased, because if it's a smaller amount, anyone today can go and start saving on a little bit note. So I think it's a good move. Maybe you don't know in terms of numbers.
Yeah, but the good part is, see, what happens is, now we deal with HNI. Volatility there is very visible. See, if there's somebody who's got 50 crores and the market falls 2%, tomorrow he opens his statement, it will be 49 crores. See, when you're looking at 250 rupee SIP, these kind of small market jolts wouldn't impact it. 15%. You have put 250 rupees for 12 months, it's 3,000 rupees, market falls 10%, to 300 rupees gone. A person won't panic with 300 rupees. The good part of this kind of initiative is going to make the base very solid, non-volatile. Retail participation is what 250 rupees SIP can bring to us.
Okay, Feroze, just quickly, interest rates. This is the most interesting topic, because understanding interest rates, budget coming in, and now how do we anticipate all this, maybe if there's any change coming in with the equity and especially the debt bond market? How do we play that story?
See, how can you play that story is first not buy the false narrative, in my opinion. What is the narrative? Repo rate ghataegi RBI. And you will make money in bonds. It's not going to happen, at least 95% likelihood. Because when repo rate went up from 4.5%, after COVID we had come down to 4.5%, it went up to 6.5%. You would be surprised the 10-year GSEC hasn't gone up at all. So when you didn't lose money in the bond portfolio when interest rates went up, is it fair to expect making money when interest rates on the repo come back from 6.5 to 4.5? No, you've not lost money. Now let's look at one example. The sharpest interest rate decrease in India is between 27 January 2009 to 21st April 2009, almost 15 years back. The interest rates were reduced by 1% in 4 months. You know how much was the capital appreciation in bonds? Minus 1%. Okay, so and in the same period, equity went up 21%. So interest rates of RBI have a larger impact on equity than on debt. So please don't expect to make a lot of capital appreciation on debt, mathematically speaking. Of course, the next 1 year could be an exception, but we have to all work on probabilities in the game of investing.
Okay, and just the last quick one is going to be in terms of now everything that we're expecting in terms of budget coming, maybe infra, whatever comes in. What are you and how are you positioning your funds in terms of your portfolios? What would you be positioning yourself as in terms of sector-wise? What is it that could see the most benefit coming in this time?
See, I think the sectors which have actually not run up, which are the banking sector. Banking sector, if I have to just tell you one sector, because that's where the heavyweights are. 27% of Nifty is banking. The fortunate part is after this correction, I personally think the banking sector will get the maximum push. Because if repo rates come down and if the flat end of the yield curve, the biggest problem with the banks is, let's assume Vinnii goes to make an FD of 1 year. If the banker told you 7% for 1 year FD and 5 year FD also is 7%, what would you choose?
I mean, I'd rather choose 1 year and finish it off. I wouldn't go
This is the problem today. My dad also chose the 1 year FD. Earlier, if I told you 7% for 1 year and 9% for 5 years, you would automatically take the 5 year.
Because I'm like more tempted.
More tempted. So that saves the banker 5 times rolling over. So the reason why deposits are not growing is not because mutual fund is taking away a lot of money. It has taken only 7% and FD has taken 43%. 43 wala ro raha hai ki 7 le gaya. Bhai. But the problem of banking is flat yield curve. If repo comes down, the flat yield curve will go away and people will get deposits for longer periods of time. Hence, banking as a sector over structural change can be played as a theme.
Okay. Feroze, thank you so much for joining in with us also. It's a pleasure having you on the show. And it's great getting to know what to expect from the budget this time, how one could start playing the story as well for the industry and what the expectation is coming in. So thank you so much for that. And viewers, with that, we're absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in.